have here. So this is going to be a brief explanation of breakers and mitigation blocks, okay? And then we're going to add a little bit of QML. We're going to address it. I believe at the end of this lesson, we're going to talk about QML a little bit. But the main purpose of this discussion is on breakers and mitigation blocks, okay? So you can see we have two structures here. This structure here, it's opposite of this structure here, and this structure here, it's opposite of this structure here. So basically they are opposite of one another, okay? So what you see here, what qualifies a structure to be a breaker? This is what we have here, which has been indicated, okay? We need to have a high, okay? And then we need to have a higher high. After that higher high has been formed, we need to see price pushing down, taking out this low here, creating a lower low, okay? So that structure, once we have such, it then qualifies now to be called a breaker structure, okay? So in this case here, what we are looking at here, we're gonna call it a bearish break, okay? It's a bearish breakup because we are anticipating to sell when price gets to this level here, okay? And then this one is a bullish breakup because we are anticipating to buy when price gets to this level here, okay? So basically that's it. So you can see here price push up, and then it gets to this level here, and then it pushed down for whatever reason that we have on the other side, okay? Whatever that we have that is causing price to push down a little bit. After it pushed down, it push up, okay? So it take out this high here, okay? So stops are being collected here, or buy side liquidity is being collected here, which is resting above these highs here. So it's being collected, price push up, and then it push down, okay? So what you want to see when it comes to breakers, QML, and mitigation block, okay, when it comes to those three, what you need to have here, you need a significant displacement, okay? So don't just wait for a spike, a little bit of a spike, and then you want to jump in and start trading. Just wait for a movement, let price move here, okay? Because the reason we call it a breaker or a mitigation block is because what price will actually do here, after price move from this level here, point C, to this level here, what we're gonna have here, we're gonna have a lot of price imbalance, okay? So price, it's gonna reprice up high just to close, okay, just to close 50% of this price imbalance that has been created, okay, or 50% of this liquidity void here. It's gonna come back to just close it, and then after closing it, then it's gonna continue to go down, okay? Because if you look at this level here, it's if you look at this level here, point B here, as the market was pushing down, it indicates a break in market structure. That's why you see BMS, okay? It stands for break in market structure. It simply means now the market structure has changed, okay? The direction of the market structure has changed. Now the market structure is going down, okay? So you can see here, as price was moving up, okay, we get to see that as price is moving up, it's taking out what previous highs, okay? So as price is busy taking out previous highs, that indicates that the market structure is bullish for that market until we had price, okay, forming the last higher high, and then immediately push down, and then it now takes this low here. Then we say we have a break in market structure, meaning price is now changed direction, okay? So basically that's it. That's the same thing that we get to see here. We have a low here, and then we have a lower low, and then we have a high here, and then we have a higher high, and then price push back to close this price imbalance that has been created. It closed back, and then it push up. So most of the time from this point, okay, of your breaker, just take your Fibonacci, you pull it from here to here. Okay, you will find that most of the time this area of your breaker here, it's close to 50%, or sometimes 50%, or sometimes a little bit above 50%. Okay, so and also if you just do the same thing here, you take it from C and then to this, you measure the displacement here, you will find that this level here, it's around 50%. So price will come back, close a little bit of that 50%, and then it continue to go down. So let's move to the next lesson. So this is what we have here. You can see I've indicated 1, 2, 3. Okay, so basically we have a break at this level here. So here I made a mistake here. This is a mistake here. I'll just clarify. This is a mistake. It's supposed to be mitigation block. Okay, so the only breaker is this one, the first one here. This is a breaker, this is a mitigation block. So this is what you can see here. Price is pushing up here. Okay, we have this high at 1, and then it pushed down. We have this low at 2, and then it push up, it takes out this high here. Now we have a higher high. Okay, so it's not yet a breaker until it takes out this low here, and then price push down, it take out this low here. So then this structure now qualifies to be a breaker structure. Okay, so what we are anticipating for, we are anticipating price to get back to this level here, or retrace to this level here, and then we're going to be look for short positions. Okay, so one thing that I need to clarify, whenever you are looking at your break, okay, the most high probability or the most likely successful breaker that you're going to be looking for, even for a mitigation, the most likely breaker that it's going to be successful or a mitigation, it's the one with the QML. Okay, I mean it's the one with the fair value gap. Okay, it's the one with the fair value gap, the breaker that is in line with the fair value gap. That's the one I trade. Okay, that's the one I trust the most when it comes to trading. You can do your own back testing after this video. Just do your own back testing, you will see what I'm talking about. So if you look here now, let's look at this one here. We have price pushing up, okay, and then push down, and then push up, and then push down. So you can see here it has a higher low. Okay, it has a higher low that has been created here. Price has a higher low that has been created, which is a mitigation block, that one. So you can see here, this is what we have here. We have price pushing up, create this high, and then it push down, and then it push up, create a higher high, and then it push down. And then we have this low here. We have this low here, and then we have this fair value gap here. And price come back to this level of our breaker. It gets to this level here, and then it push down. And after it push down, it push up a little bit, and it gets to this level here, and then it close, and then it comes down. So this is what we have. This is the US dollar index. So you can see here, this is A, B, C. Okay, so this structure qualifies to be a break. Okay, so we have a high here, we have a higher high, we have a low here. So price push down a little bit, it leaves a fair value gap behind. That's what we want, and then it push back to that level, and then it drop. Okay, same thing that you get to see here at this level here. You can see that we have this low here, we have a lower low being created, and then we have a high here, and that high is being taken out. After taking it out, price comes back, and if you get to look at here, we have what? We have a fair value gap here lining up with your breaker level. So price gets to this level, and it quickly move away. same thing that we get to see here. You have your breaker level here, and then you have your fair value gap here. These are fair value gap here, and then you have your breaker level in line with your fair value gap, and price gets to that level, and then it quickly push away. Okay, so same thing that you get to see here. You have your low, you have your lower low, and then you have your high here being taken out, and then we have this level of your breaker here. Price comes back to that level of your breaker, and then it pushed down a little bit, didn't get to this fair value gap here, but it got to this level here, which is what we call volume imbalance. Okay, so this level here is volume imbalance, but it's not part of this discussion. We're going to discuss it later. So price pushed to this volume imbalance here, touch it a little bit. That's the reason it doesn't get to this fair value gap here. So then it push up a little bit. So we're going to look at mitigation block. Okay, so the difference between a mitigation and a breaker block. A mitigation block has a failure swing, whilst on a breaker there is a stop run. Okay, so a mitigation block has a failure swing, while on a breaker there is a stop run. So what do I mean by that? Let me just okay, I can't get to paste something here, so let me just look for something to put it here so that I get to show you the difference. Okay, you can see now this structure here, it's not a mitigation block, it's a QML structure. It's a breaker structure, sorry. So these are breaker structure here. Okay, you can see price push up, push down, and then we have a higher high. Instead, we have a what on a mitigation block? On a mitigation block, we have a failure swing. Okay, so on a mitigation block, we have a failure swing, whilst on a breaker, we have higher high being created. Okay, or a successful swing being created. Okay, yet here we have a failure swing. Here we have a successful swing being created, or you can say here we have stop run. Okay, here we have stop run. Here we have price failing, okay, to take out these stop runs that are resting here. So this is what we call a mitigation block, and this is what we call a breaker. That's the difference. So this is a mitigation block structure. It's just the opposite of this one. This is a bearish mitigation block. Reason being, we are anticipating to sell at this level here, and then this is a bullish mitigation block structure because we are anticipating to buy at this level here. So this is what we have here. You can see this 4-hour time frame, the Australian US dollar. So you can see here, the Australian versus the US dollar. So you can see here price formed this low here, and then it push up from this higher low here, and then it push up, take out this level here, and then after taking out this level here, it push down a little bit, get to this level here of your mitigation block. This is the level of your mitigation block here, and you can see here you have a fair value gap here. If you just look at here, you have a fair value gap here. It gets to this level here and it quickly goes up. Okay, so you can see here as price was moving up here, you can see that now price has momentum. You can see with the candles, you can see with the candles here that they are long candles, and it's quickly showing momentum that okay, it's most likely to continue to go up very fast. Okay, so it doesn't do like this thing of moving, coming back and forth, coming back and forth. No, it's just straightforward price action, straightforward price action, green candles, very quick. So this is what we have. This is the same example I was showing you. So but now I just wanted to highlight this fair value gap here and also this breaker level here. So we have this fair value gap here, we have this breaker level, price comes back, close the fair value gap, and then it gets to the breaker level here, and then it quickly push up. Okay, so what you're going to be targeting, so what's going to be your target here? Here it's very easy. You can see we have relative equal highs here. That's going to be your target. Okay, so these was going to be your target here. So you can see here we have the same thing here. Okay, we have price pushing down and then coming up to this level here, which is an order block here, and then push down after that. Therefore now we have a what? We have a mitigation block. Okay, because we have a high here, and then we have a higher low, and then we have this low being taken out. Okay, so therefore this now qualifies to be a mitigation block, and you can see that our price pushback gets to this level of our mitigation block, it closed it, and then it quickly changed direction. And guess what? You can see that our mitigation block is in line with our fair value gap here. Okay, so that's a high probability mitigation block. So you can see also here we have a lot of what? We have a lot of displacement here. Okay, there is enough imbalance, or there is enough liquidity void here. Okay, so price push back just to close it, and then it pushed down. The same thing happens here. You can see we have a mitigation block, it pushed just to close it, and it's in line with your fair value gap here. Okay, so basically that's it. There is nothing difficult about it. It's the same thing we get to have here. Same thing here, price come back to this level here, and then it pushed down. So now we already spoke about the QML trading, and we already spoke about QML trading versus breaker. But what I want you to keep in mind, it's very simple. Okay, that a breaker structure, it's literally a QML structure. Basically it's the same structure. Okay, so the only difference is whenever we're talking about a breaker structure, what we are anticipating price to get to this level here, and this is where we're going to be looking for our trade. Okay, so but then on a QML structure, this is where we're going to be looking for our setup. Okay, so this is the level where we're going to be anticipating a sell setup. Okay, yet on a breaker structure, this is the level we're going to be looking for our sell setup. Okay, so the only difference between the QML and a breaker, it's where we anticipate to enter. Okay, our sell position or our buy position. Okay, so it's where we anticipate to make our trade. So but since now we already have established and we already have the understanding of breaker, okay, a breaker structure. Okay, so if we look at the QML structure, basically what happens is that when it gets to this level here of our breaker level, because this is the same structure. Okay, within a QML structure there is a breaker structure because it's the same structure. So you can see here we have this level here which we call our breaker level. Okay, guess what happens when price gets to that level? It will push. Okay, and then from that level here it's sell short. Okay, after selling short at that level, guess what we have according to QML trading concept? We call this high here an FTR. Okay, And FTR simply stands for, or simply means, failure to return or to retest. Okay, so it simply means we were anticipating price to get to this level here, but for some reason, which is our breaker level, it failed to return to this level here. So that's why this level here, it's called an FTR. And you hear a lot of people talking about an FTR. That's what they are talking about. Okay, so now you have an advantage since you know a breaker structure. Okay, so you know that, okay, what what cause an FTR? It's the breaker level. So you can trade this level here. Okay, instead of just waiting for price to get here and then all of a sudden an FTR is being formed and price push down and delay your setup and you are still waiting. So you can just take advantage of this while you are waiting for price to get to this level of your main setup and then it push down. So that's the end of this discussion.